Recessions create more millionaires than any other time, like you said, because when you have a recession, a market crash, people get scared and then they sell their assets. What's an asset? Stocks, real estate, crypto, gold. It can be any type of investment depending on what the crash is, what the recession is about. And that then creates a buying opportunity for somebody who has access to cash or capital and somebody who is financially educated. So if you have the cash, you're prepared, and you have the education of knowing what to buy, well, now a crash creates a discount for you to come in and buy an investment on sale. You could think of it like Black Friday for investors. You get to go shopping at a discounted price because now people are selling because they're scared. And what you want to look for now is good investments that are being hurt, not because their investment is on the verge of bankruptcy, but because the economy is pushing the price of good investments down. So that's kind of in a nutshell, to answer your question what that means. But now if we dive a little bit deeper, we go a little bit higher level, how do you do this? What does it mean? Well, if you ask the majority of people, or if you just ask anybody, is a recession a good thing or a bad thing? Most people are going to say it's a bad thing. But it's really relative depending on which side of the equation that you're on. See, it's bad for so many people because recession means, I might lose my job. I might lose my home. I might lose my savings. So it's bad in that sense where if you're not prepared, you might not be able to weather the storm and you might get financially hurt. We've seen this happen forever now, that anytime you see a bubble burst, the people who are not financially educated, the people who are not prepared, the people who don't understand what's going on in the economy get burned.
I remember the first time it occurred to me, I was like, wait a second, if I don't lose my job, then a recession doesn't impact me. Now that was before I had any money invested, so now I have a better understanding of if you're counting on income or whatever from your investments, then it can still be a dicey period. But that was one of those things, like a recession was a boogeyman. It was like something to be afraid of, but I didn't really understand why I was supposed to be afraid. And so my question is, why do people get scared in a recession? What is it that makes them sell? I'll give you a very specific thing. So in crypto, I haven't, even though the prices plummeted, I haven't sold a single ETH, not a single Satoshi. I've just been holding, not tense about it. So why do so many people get scared in a recession?
So there's two reasons why someone sells. Either it's a forceful sale or it's a voluntary sale. The voluntary sale is a little bit easier to understand, so I'll explain that first. So when the 2020 pandemic hit, we saw the stock market crash. Now, I think most of us understand.
And crash has a definition, by the way.
Well, yeah, crash, bear market is when you see the market fall by 20% or more. Now, the stock market, when the economy shut down in March of 2020, we saw the fastest stock market crash in the history of time. Now, naturally, people got scared.
Faster than
Great Depression.
Whoa.
People got scared. And I think most of us understand that your 401k, for example, is a retirement plan that you don't want to touch until you are near retirement. What happened? Well, we saw a massive amount of people sell out of their 401ks near the bottom of the 2020 stock market crash.
Because they're convinced it's just going to keep going lower, and it's like, I got to get out now.
You just see your portfolio in the red. You lose 10, 20, 30, 40, 50%. You get scared, and you're like, I want to save whatever money that I can, because you don't understand what's going to happen. I mean, if you look at it from the last 100 years chart, you'll see that crashes happen, but then each time they happen, our economy is stronger, rebounds, and the market moves higher. But we get this like narrow vision where we're looking at today, tomorrow, the day after, next week, and now we want to pull out as fast as we can to save, quote unquote, save our money, and so you sell. So this is a voluntary sell where now you get scared, you panic. People talk about how the world is ending. I mean, the media is in the business of selling hype. Okay, it's as unfortunate as it is, you have to understand this. Things are typically never as bad as they seem, and things are typically never as good as they make it seem. So it's typically somewhere in the middle. And so now when you know that, you'll understand that, okay, the stock market is a liquid investment, meaning you can buy and sell a stock with the click of a button. I can buy and sell a share of a company literally within 2 seconds. And so what does that mean? Well, if I start reading headlines, I see the market going down and start getting this anxiety, I start getting this fear, I might just want to sell. I mean, I can do it in 2 buttons. And if all my friends talk about how they're selling, how they're losing money, and the media keeps talking about how the market's collapsing, the world is going to end, because the media is either going to say the world is ending or nothing bad will ever happen.
Right.
It's typically one of these two extremes because that's what drives them.
And I want to get to that. That's one of the things I'm going to push you on later is like, I've heard you talk about this. People lie a lot.
They do.
And then they come out and admit, yeah, we were lying, but we had a reason. But I won't derail this now, but like that kind of stuff freaks me out.
And it's the reality of life. And we'll talk about that. So now if you understand that, what does that do? It manipulates people's emotions. Emotions then drive our actions. And what are these actions? We sell at the bottom and then we buy at the top. Because at the top is the same thing. People say, oh, everyone's making money on the stock. You can't believe how much money these 17-year-old kids from high school are making. You can't believe how much this hedge fund made. You can't believe how much money whatever your neighbor made, and now you get jealous. You get this FOMO. You don't want to miss out. You come in and buy. Then at the bottom is the opposite emotion. So that's the voluntary sell, because most of us don't have the psychology, which is a part of the financial education of how to manage our investments. The second is the forceful sale. Now, the simplest example that I can give you of this will be if we look back to the 2008 real estate crash. Now, if you bought a home for $400,000 and you had a adjustable rate mortgage, which was very common back then.
And it's getting common again now.
It is getting very common again, which is very bad news, but they were very common. And another thing that was very common back then was a 0% down payment. But let's assume you put a little bit of money down because you wanted to put some skin in the game. So you put a little bit of money down, you put 3 to 5%, maybe 10% down. Well, what happened was a few years after you bought the home, interest rates went up, and now you realize...
Really fast, I want to walk people through what an ARM is. So an adjustable rate mortgage, I had one. If I had known how dicey it was, I would not have done it. So an adjustable rate mortgage, you're basically betting that the future is going to be better than the current moment. So you take something with a certain interest rate, and you're like, okay, I'm going to be able to refinance. Either the value of my home is going to go up or interest rates are going to come down, whatever. But I'm going to be able to refinance my home, so the story goes, or I'm going to be able to pay it off, whatever, before that huge increase. And you are betting literally your house that you're going to be able to either make enough money to cover the increase, or that you'll be able to sell your house at a price that you like, or be able to refinance it before that happens.
Exactly.
It is so dicey, so people end up getting in these insane situations. That tends to go along with when people are getting pretty loose and fast about not expecting as much money up front. So now you don't have any equity in the property. You get upside down, meaning that the house is worth less than you owe. So even if you sold it, you're going to be selling it for a loss. And so now you're in this really dark spot where you can't sell it. The interest rate just jumped, sometimes dramatically. And so now you owe significantly more. I mean, it could be 50% more, 100% more, and you're just in a really, but you can't get out from under it unless you just let them foreclose on you.
If you're enjoying this video and want to take your investing to the next level, I want to remind you that I put together a free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. It's a completely free masterclass, and when you register, you'll also get access to Market Briefs, which is my newsletter for investors, completely free, complimentary as a bonus. So if you want to get the investing masterclass and Market Briefs all for free, all you have to do is click the link down in the description below to get it.
Or you have to find a way to pay that money. And it is, speaking from experience, I was so convinced that my life would be in a fundamentally different place than it was when I took it. So I put a 5-year bet on myself. And dude, it ended up working, but oh my God. In the intervening 5 years, I became so much more financially literate that I was like, what was I doing? Like, that was the most dangerous thing I could have possibly done.
It's a very dangerous vehicle when it's given with no financial education. And the problem is it's not given with any financial education, because see, a banker, so I'm gonna just explain this for a second. A banker is in the business of making money. How do they make money? By selling you money. So they're trying to sell you as many loans as possible. And now if you're looking at this $400,000 home, and let's just assume for rough numbers that the mortgage on this $400,000 home is $2,000 a month. And you might say, I'm kind of stretching myself a little thin, but I want to own this home. The banker doesn't want you to not buy the home, because if you don't buy the home, they don't get paid. So now what they can do is say, well, how about you buy this $400,000 home? You don't pay $2,000 a month, but instead you just pay $900 a month. Oh, are you telling me I can buy this $400,000 home for $900 a month with nothing down? Yeah, how about you have this free TV as well? Because there was promotions back then where they would give you a free TV, you literally put no money down, and now you can buy this home. And so what was happening is people were buying these types of homes with these types of deals, thinking they have this amazing price, $900 a month. And it was given with zero to extremely little financial education, because then what would happen is after a number of years, your interest rate would readjust because you were given this low teaser rate for the first few years. And the pitch was, well, don't worry about it. Home prices always go up. So if home prices continue to go up, or not if, when home prices go up in a few years, if you can't make the payments, don't worry about it. Just refinance out or sell the home, and then you have cash in your pocket. So what could go wrong? And this was the pitch. Now, again, many people are not financially educated. We're not taught about money in school. So that was the first aspect. The second aspect was these loan officers, banks, are incentivized very heavily to sell as many mortgages as possible, because the more mortgages you can sell in a month, the bigger your bonus is. And so you had these two aspects happening. So now you bought this $400,000 home, you pay $900 a month, and things are great. Then a few years go by, you get this letter in the mail saying your payment's going to go from $900 a month to, let's just say, $2,000 a month. Now, if you don't have the ability to pay this extra $1,100 a month, you're going to say, oh, that's quite a bit. Oh, well, no big deal. Let me call up my banker and tell him the situation, and he'll tell me what my best options are, because my banker is a good financial advisor, right? You call up the banker, say, hey, banker, I can't afford this $2,000 a month. What are my options? He says, well, you can refinance or you can sell. This is what was happening now, getting closer to 2008. And so you said, okay, well, let's get an appraisal, or let's look at the value of the home. You bought it at $400,000. Now you maybe owe $380,000 over the first few years, because the first few years of your mortgage are interest heavy, meaning the majority of your monthly payment is going towards interest, not paying down your balance. And so now they look at it and they say, so the value of your home is now $350,000. You owe $370,000, $380,000, meaning you're underwater. So now if you owe $380,000 on a $350,000 home, no bank is going to want to refinance, because now you're underwater. They're not going to want to re-lend you any more money. Otherwise, you're going to have to bring cash to the table. You can't sell the home, because if you sell your home for $350,000, you need to still pay the bank the other $380,000. So you need the $30,000 coming out of your pocket. And if you don't have $30,000, you can't sell. So what's the next option? Well, if you can't make the monthly payment, either you're going to walk away, or the bank is going to force you to walk away through a foreclosure. This is now a forced sale. So now the bank comes in, they take the home from you, and now the bank wants to liquidate, because they want to not own properties. They want to just lend money. That's their business. They don't want to own homes. And so that was what happened. And so many more homes hit the market. You see the same thing happen in the stock market, when you buy stocks on margin. And now what does that mean? It means you're using debt to buy stocks. And when you use debt to buy stocks, your lender, your brokerage doesn't want to see your portfolio fall by a certain amount. If it falls by a certain amount, they're going to ask you now to cover, meaning put some money in. And if you don't have this extra cash, the reserves to put more money in, because you thought your investment was going to go up, so you went all in, well, now they're going to force you to sell. And that is now, again, a forced sale. So now markets are going down. What causes people to sell? Either voluntary, because you get panicky, you get scared, you get worried, or you think you have a bad investment, so you want to exit as fast as possible. Or on the flip side, it's a forced sale, where now you used debt and you were over leveraged, and now you're underwater, and now you're being forced to sell. So what does this do? This increases the supply of this asset. Now, again, what is an asset? Stocks, real estate, crypto. It can be any asset out there, an investment. So now when you increase the supply of this asset, well, that can now bring the price of things down, because the price of anything, really, whether it's an asset or something else, depends on supply and demand. When you have a lot of supply of something with no demand or very little demand, the price of this thing is going to fall, because now all the sellers are fighting against each other to get somebody to buy it. On the flip side, when you have a lot of demand but no supply, the price of this is going to go up. This has been the real estate market for the last 2 years or so. We have had this massive demand of people wanting to buy homes. Why? Well, for one, the pandemic changed our workforce, where now you can work from home. So people want a home with an office in the home. Second, people want to move out of the big cities because they realize like, if I can work from home, I don't got to pay this $5,000 a month in Manhattan. I can go live in a suburb and pay a fourth of that and have a bigger home. And then third, mortgage rates were the lowest that we have ever seen ever. In the history of American modern history, we've never seen mortgage rates this low. So this created a massive demand, meaning people wanting to buy homes. So you had this flood of people wanting to buy homes while the supply of homes was extremely low. So some people didn't want to sell because they were worried about the pandemic. They didn't want people to come in their homes who could have potentially been sick. Second, builders couldn't build homes because we had a labor shortage. We had, and still are facing, supply chain issues. So what does that mean? You want to build a home. Well, do you remember there was a period where there was a huge spike in lumber costs? Builders could not get access to certain materials. Certain materials were backed up. It was harder to find labor, to find workers to help build the home. And then on top of that, the cost kept going up because now workers wanted more money. The cost of materials kept going up. So it was this big dilemma in the building side. So the inventory of homes was artificially low. You could not build more homes. So for the last 18 months or so, 2 years, we saw the situation where demand was through the roof, literally, and supply was very low. Some of the lowest supply levels that we've ever seen. That pushed home prices up at the fastest rates, essentially, ever. And now we're starting to see that slow down, where now demand is starting to go down because mortgage rates have gone up so significantly. People are looking at the higher prices of homes, saying, I don't want to pay this higher price. So that is starting to flip. But this is where, understanding how supply and demand works, and you now, as a financially educated person, as an investor, what you want to be looking for now, when you see market slowdowns, a recession, a crash, what you want to be looking for is not the emotion, but now cutting through the noise, cutting through the media, but now looking for the actual financial fundamental investments where you have a good asset, a good investment that's being hurt by the economy, that would now you can come in and buy it at a discounted price. And that's what you want to be doing. And that's, I don't want to keep going on this same topic, but after the 2008 crash happened, that's when I first started buying real estate. And I think we talked about this before. I didn't understand what was going on. I was 19. I had some cash saved up because I was running some entrepreneurial ventures. Detroit, which is kind of my home base, Metro Detroit, Ford, GM, and Chrysler were the main drivers of our economy. GM went bankrupt, Chrysler went bankrupt, Ford was on the verge of bankruptcy. So the Michigan real estate market was hit exceptionally hard. And real estate prices had fallen by 90 to 92% in some instances.
Oh my God.
And so that was where I was able to come in. I didn't know all this. Like, I look back and I understand this now. But I was 19, I had a little bit of cash saved up, and that was when I bought my first rental property because I didn't have any real estate mentors or guidance or people. I didn't know any real estate investors. My first real estate property was an $8,000 condo. I bought it out of foreclosure from the bank. And previous to me buying it, it had sold for $150,000 just a few years prior. And that was just the market where there was nobody there to buy it. People thought that I was the crazy one, the dumb one for wanting to go and buy real estate when the world was ending, when real estate was collapsing, when nobody wanted to own real estate. Everybody told me that I had lost my mind. But that was the situation. And you have to understand the psychology. I've said this before, I'm gonna say it again. History, while it does not repeat itself, it does rhyme.